Hey, what's up guys? Hope you're doing great. Today, I will be explaining you how to calculate the PE ratio and the importance of it when we are about to analyze a stock. The price to earnings ratio, or PER, is the ratio for valuing a company that measures its shares price at the moment relative to its earnings per share. It is also sometimes referred as the price multiple or the earnings multiple. As analysts or investors, we use the PE ratio to define the relative value of a company's share in an apples-to-apples comparison. It can also be used to contrast a company against its own historical data or to compare aggregate markets against one another or over time. To determine the PE value, we simply must divide the current stock price by the earnings per share or EPS. The current stock price can be found by plugging the stock ticker symbol into any financial website, and although this concrete value reflects what investors must currently pay for a stock, the EPS is a slightly more nebulous figure. EPS comes in two main varieties. The first is a metric listed in the fundamentals section of most finance sites with the notation PE or TTM, where TTM is a Wall Street acronym for trailing 12 months. This number signals the company's performance over the past 12 months. The second type of EPS is found in a company's earnings release, which often provides the EPS guidance. This is the company's best educated guess of what it expects to earn in the future. As an example, let's calculate the PER for Walmart as of April 2020, when the company's stock price closed at $121. The company's profit for the fiscal year ending January 2020 was $14.8 billion, and its number of shares outstanding was 2.83 billion. Its EPS can be calculated as 14.8 billion divided by 2.83 billion, resulting in $5.22. Therefore, $121 divided by this $5.22 gives us, for Walmart, a PE ratio of 23 for that moment. Let's see another example, this time for McDonald's. McDonald's net income for the 12 months ending March 2020 was $5.8 billion, and its number of shares outstanding is 751 million. These divisions give us a result of $7.72. Then, when we divide the current stock price, which is around $185, brings us a PE ratio of 24. Occasionally, as analysts, we need to understand long-term valuation trends and may be reasonable to consider the PE10 or PE30 measures, which average the past 10 or 30 years of earnings respectively. These measures are often used when trying to scale the overall value of a stock index, like the S&P 500, since these longer-term measures can compensate for changes in the business cycle. The PE ratio of the S&P 500 has fluctuated from a low of around 6 times during 1949 to over 120 times in 2009. The long-term average PE ratio for the S&P 500 is around 15 times, meaning that the stocks that make up the index collectively command a premium 15 times greater than their weighted average earnings. An individual company PER is much more significant when taking parallel PER of other companies within the same sector. For example, an energy company may have a high PE ratio, but this may reflect a trend within the sector rather than one merely within the individual company. An individual company's high PE ratio, for example, will be less cause for concern when the entire sector has high PE ratios. Moreover, because a company's debt can affect both the prices of shares and the company's earnings, leverage can skew the PE ratios as well. For example, suppose there are two similar companies that differ primarily in the amount of debt that they take on. The one with more debt will likely have a lower PE value than the one with less debt. However, if business is good, the one with more debt stands to see higher earnings because of the risk it has taken. Another important limitation of price-to-earnings ratio is one that lies within the formula for calculating the PE itself. Accurate presentations of PE ratios rely on accurate inputs of the market value of shares and of accurate earnings per share estimates. The market determines the prices of shares through its continuous action. The printed prices are available from a wide variety of reliable sources. However, the source for earnings information is ultimately the company themselves. This single source of data is more easily manipulated, so analysts and investors place trust the company's officers to provide accurate information. If that trust is perceived to be broken, the stock will be considered more risky and therefore less valuable. So that's it for today, guys. I hope you enjoyed this video, and I hope that this video helped you to understand better what is the PE ratio or PER. As you might know by now, I will be uploading at least 2 videos per week, so stay tuned and have a good time.